Good evening, everyone. This is Henry Gamble with SimplerOptions.com, and in today's free video I wanted to give you 3 different ways to look at playing really any underlying that you're approaching in this market. I think it's a little bit of a tricky situation because from some perspectives, and really I think Amazon is a great ticker to talk about this, but from some perspectives you would look at it and say, this squeeze has still fired short, and there is no reason to fight a short squeeze until the momentum has truly reversed. You could also say that this is a bit oversold. It's a far cry from its 21 period moving average, and a snapback could be coming at any time. All of these I think are valid arguments, and these are a couple of ways that I will look to play them this week and into the next. Now when we look at a chain of Amazon, and this is also a good example for a lot of the tickers that you'll be looking at in the weeks ahead, but just be mindful of your implied volatility, and when you see these sharp jumps in the IV, you know that this is probably the series where Amazon is going to report earnings. So that tells me if I want to play it technically, I can use these options with 4 days of life left. If I want to play it more off of the implied volatility and around earnings, that's where I will step out these 11 days and focus on those contracts. For the sake of today's discussion, let's keep this here in the January weeklies, and the 3 ways that I would look to play this. The first of which is just an iron condor. So 550 I think will offer a decent area of support, and 600 will offer a decent area of resistance. That iron condor is going for about a $2 credit if you do it 5 wide. I would also look for, if you get filled on that and the market really starts to catch a bid this week, maybe tacking on an extra 550 short put to work that reversion to the mean, and that's one way to play those. The other way that I would look at doing this, all still here in the January front week options, is concerning something like a broken wing butterfly. Now I would wait to put this on to see if we're actually going to see some strength from the indexes this morning, and of course if we open up down hard on Tuesday, I think you could still apply these strategies, but you may adjust the strike you're looking at. Let's say from right here, this is something where we are looking for a bounce on Tuesday and into Wednesday. If that can really get some strength, I will look at doing things like buying a 580, selling the 585, and then breaking the wing of this, so if Amazon explodes higher, I won't lose money to the buy side. I won't do as well as if it would hover near 585, but breaking that wing makes that a little bit more of a feasible strategy if the short covering rally really does take hold. It also is a fairly inexpensive strategy. The third one that I was going to look at, and this is a bit more of a Hail Mary. It's interesting to me in Amazon simply because they have earnings, and because I think 600 could be a viable strike price, not to mention, or an attractive strike price I should say, but not to mention the expected move would take you exactly into 600. So from that, and of course like I said, this is a bit of a long shot, but the idea of doing a 10 wide butterfly around 600, this is going here around 65 cents or so. And this would be a way that if Amazon really does catch fire, you're essentially risking 65 cents to try and make $8 or so. Obviously the max profit in those butterflies is very rarely realized, but if you can get above 590, things get interesting, and I think it makes for an interesting risk reward. So there's 3 different ways to play it, depending on how you like to structure your options trades. Hopefully that helps as we get into the earnings season and navigate this higher volatility. And I will see you at the next free video.